Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleague Surabhi, and Nigel is back from his holiday. Guys, good morning.
Hi, morning. Good to have Nigel back, fresh from the mountains, and we've got the market primed up for your return.
Well, that's right. I had a great vacation. I was away in the mountains, and the joys, the simple joys of life, right? Fresh air, clean water, sourcing your wood for the evening. I'm feeling refreshed, and I think you guys should try it as well. In rural India, I mean, there's so much to look at. I lived in a small village in Uttarakhand for all of 7 days. Market action was great. I'll tell you what, I had a really, really good time.
All right. Well, it's the mountains always refreshing.
Yeah,
absolutely refreshing. Well, let's just quickly run you through what you need to know as we begin this new week, because the last week was a fantastic one. The market started on a sort of very, very, very strong note and then kept building on it. And it's unlike what we've seen for many months now. So let me start there with just a quick sampling of what we saw. We basically were up 5 days in a row. Well, you'll say, well, so what? 5 days in a row? Well, it was the first in 7 months that we've had 5 days up. This is, of course, the market topped out in late September. And after that, it's essentially been extremely tough trading days. Last week, we got a bit of a relief. Actually, not a bit of a relief, a fair bit of relief. So gains kept broadening. That's the other point. Small caps and mid caps joined in. It looked like large caps only, but then mid and small caps rallied hard. Just to put the numbers up in terms of what we've done now from the lows of the 3rd of March, they're up on your screen. The Nifty is up about 6%. The Nifty Bank is up about 6%. Mid-cap index is up 10.5%, and the small-cap index is up 13%. So these are massive moves coming through in terms of what we've seen. Now, let's just sort of come back to the local markets with levels, etc. in a bit. But let's recap the global setup as well. So for global markets, while we were having this, rocket of a time, it was quiet. And last week, macro-wise, also not very much. It's not as if the dollar, all the moves in the dollar yields, etc., happened till the end of the week before last. Last week was not very big in terms of moves at all. Nasdaq on Friday specifically, 0.5% higher. Dollar index has been creeping up 3 days in a row now. We are back above the 104 mark. Now, of course, as we look ahead, it's essentially, the countdown to the tariffs day, which is the 2nd of April, reciprocal tariffs day. Remember, 1st of April is when Trump's team is going to present to him the review of America First policy, and the 2nd of April is when the reciprocal tariffs are to be announced. There is enormous amount of uncertainty around what is coming, right? And this is in various ways, whether they're going to go everything on the table, whether they're going to do a phase-in, which is they start small and then maybe the impact is dented. Which countries, etc., etc. Recent comments have been suggestive of the fact that the Trump team is saying that tariffs will be more blunt than they will be precise. Trump has again and again said, I think over the weekend also, he put out a post saying 2nd of April is going to be U.S. Liberation Day. So, he's kind of obviously building it up. But there are also headlines over the weekend. And this is with regards to, I think Bloomberg carried a story, quoting sources, of course, that tariffs may be more targeted than previously expected. Actually, the story goes on to say that there may be some exemptions as well. I think the Wall Street Journal also picked up that story. We just don't know so far till the last Friday, the message being that it's going to be broad-based, going to be big. Now they're saying over the weekend, at least news reports, source-based news reports are saying perhaps maybe more targeted. And there is a huge amount of uncertainty. Remember, the market's done extremely well here, and now you're running into this big event. Will we see some pause? Will we see, the market wait and see, and then let's decide? It's possible. And I think that would be wise as well. The next upside level, in any case, as I've been saying for at least 2 weeks now, the market's headed higher. The next level on the upside is 23,500. 23,600 is a 38% retracement. of the entire fall that we've had from the highs to the low. But between where we left off and 23,600, 23,497 is the immediate resistance. The February high then comes up, which is 23,807, which is also going to be an important resistance. So 23.5, 23.6, and then 23,807. Support stands at the 40-hourly exponential moving average, which has also been pulled higher. That number stands at 22,960. And the Nifty Bank is basically back at the February highs. The resistance here is 51,085 and 51,883, which is the 50% and 61.8% retracement of the fall. And support here also is at the 40-hourly exponential, which is 49,555. So, I mean, you know, I would say the way to kind of tackle from here to then, to post 2nd of April, is going to be maybe right before the 2nd of April or maybe even before that. By the way, I think the uptick that we're seeing is also correlated with the S&P, and that is because of the weekend Bloomberg story. The S&P mini futures are up 0.5% after that weekend story hit, that the tariffs may be more targeted. But as I said, we just don't know. And maybe closer to the 2nd of April, you may get a bit of a wobble. People may hold back. Very, very natural for that to happen. And if there are large numbers which are put on the table, the market takes a dip, which then perhaps may be a bit of a buying opportunity. But it's all up in the air. The market's done very well. And I think we'll have to just see what comes our way in terms of tariffs, etc. 100 points higher on the GIFT Nifty. We'll see if those gains hold. Guys.
Absolutely. And the GIFT Nifty this morning is also higher because US futures are substantially higher. There's a 0.5% upwards bid already on all the futures, S&P 500, Dow and the NASDAQ. And some of this has to do with a statement that Mr. Trump made on Friday. Then there was analysis over it over the weekend. He basically said that there can be some flexibility, but basically it's reciprocal. So his usage of the word flexibility got people a little excited in terms of whether there will be back and forth, there will be negotiation, where sort of April 2 is maybe not end of the world kind of a day. They've anyway said they start with one particular tariff number assigned to every country, and maybe then there's some scope for negotiation and quote-unquote flexibility. Anyway, as markets await that, Asia is very flat this morning, absolutely no major directional moves anywhere, whether you're looking at Japanese equities, China, Hong Kong, it's all extremely flat. Let's get some of those markets up on the screen. So not much happening. By the way, Mr. Trump also said that at some point he will be interacting with the Chinese leader this week, Mr. Xi Jinping. We don't have timelines to that, but he said that he will be talking to Xi Jinping this week. So that's also something that the market's going to watch out for. Ahead of that, equities are very, very quiet. The currency market saw more of a move, given the fact that the dollar has managed to inch back to 104. That led to a bit of a downside pressure finally on the euro. Some profit taking given the huge surge. Remember, last week the euro was above 1.09 as well. So from there, it's cooled off a little bit. The yen's also seeing a bit of a recovery move. Brent is the only concern for the Indian market in terms of the global cues, because by the time the US actions shut on Friday, the figure was 72 on the screen once again. It's come off a little bit right now, and that's because there's some chatter about how OPEC Plus will rein in overproduction, and also the fact that these additional sanctions that have come in on Iran that the US has announced, they could take about 1 million barrels off the market. So that's that's the reason behind that upward move on Brent prices. Now let's come to the fund flow picture. Look at the bazooka buying in cash on Friday. Nigel's going to talk about the F&O space in just a bit. That's 7,400 crores of net buying. Remember the days we were being slammed with 8,000 crores of selling? Well, these things turn, and it seems that they have, at least for now, 7,470. Domestic institutions were actually on the sell side, about 3,200 crores. The comeback last week has been fierce, ferocious and strong, and the bulls will see if they can build above that. Small cap index 8.5%, mid cap index 7.7%. Nifty Bank up over 5%, and the Nifty itself up over 4% last week. So can we get to more? A lot of the average, the daily moving averages, 20 and 50, they were already taken out last week. The 100-day comes into play right now, which is at 23,521. So it's looking very, very good. Let's see if the bulls can build on it. Very quickly, some stocks and news. Motilal Oswal Financial Services, the promoter entities, Mr. Motilal Oswal himself, Mr. Ramdev Agarwal and the foundation, they'll be selling a small quantity in the market, but they've clarified that this is for philanthropic purposes. There's UCO Bank, which has launched a 2,000 crore QIP. And watch out for Apollo Hospitals, at a slightly complex deal that was happening with Kaimed, the promoter entity, where they've merged with 24/7 with Apollo Health Co. Now, Apollo Hospitals, the listed entity, is buying 11.2% stake. So let's just just go over the details and we'll see. That will definitely keep the stock in focus as well. But Nigel, we got the bulls fighting again, the animal spirits fired up, waiting to welcome you back.
Well, that's right. There are two big cues that I'm going to be tracking from here on. So the first cue is going to be the FI numbers. That's going to be important. In Friday's trading session, as you all said, there was a big bazooka buy number, but that was skewed because of the FTSE rebalance, that we saw. So that's going to be one factor. The FIs, well, they seem to have reduced their selling. You don't want to see a return of the big net sell number, and hopefully that turns into buying. So that's going to be point number one. Point number two is going to be Liberation Day. That's on April 2nd. And then we'll get clarity with regard to tariffs, counter tariffs, and reciprocal tariffs as well. So these are going to be the top cues in the near future itself. Now, the power of short covering, that was on display on all of last week. And that's why, I've been making this point non-stop that a net short market actually is a blessing in disguise. And just take a look at the way it's moved. If you look at the short positioning, this is the FI net short positioning. It has halved in the last 1 week or so. And coinciding with that, you have a 1,000-point rally on the Nifty. Beautiful looking graph, right? So you have a 1,000-point rally on the Nifty, while the FI net short positions have halved. All of this in a matter of a week. And that's the reason that you say that a net short market actually could be a blessing in disguise. That's the way it's played out. Well, let's move on to a couple of other cues then. Just take a look at the FI positioning, both on index futures. Well, the swing factor here is close to around 80,000 contracts in a single week. Because they've added longs, they've covered shorts, close to around 80 to around 90,000 contracts. Even on stock futures, if you look at it, there's close to around 2 lakh contracts swing out here. Because they've added long positions, they've asked as net long on stock futures, but they've covered some shorts and they're built on to the longs as well. Which brings us to what's the positioning on index futures? Well, I recall that the net short positions were around 85%, 85%. That's come down to around 68%. So the bulk of that short covering, majority of it, just in the near term, seems to have played out. And that's what the FI positioning is at. But look at the clients. They are the ones that have got it right. And in this bounce, they've gradually been reducing their long positioning. They were at around 1.3 lakh contracts on the long side. That number has come down to around 51,000 contracts, which makes you wonder, with so much of uncertainty just in the near term, maybe booking some profit at the higher levels may not be such a bad thing, going by what the clients are doing. That's the important option data. Well, the 23,000 put added close to around 37 lakh shares. The premium's close to around 30 rupees or thereabouts. You just punch in that number and you'll get the near-term support. So both the Nifty and the Nifty Bank, all eyes are going to be on the 200 DMA now. Can they get to that mark? These are the important mark. That's where the 200 DMA comes in at. This is the important support for the Nifty going by the options data. And that's where the 50 DMA as well comes in at. And if you're looking at the Nifty Bank, we have seen these, it's revisited these lows in the last couple of trading sessions. So this becomes the important support zone. 200 DMA on the upside. And these are the levels that you want to look on the downside as well. Stocks that I'm looking at, well, I'm looking at IFB Industries. This is the stock that has halved from the recent peak. In October, it was close to around 2,300 rupees. It's come down drastically. Now, what's happened is it's conquered the 20 DMA. The 50 DMA is a little distance away. But in the last week, there were two sessions where you have massive delivery-based buying with close to around 80 to 90% of the total traded volume was delivered. So I'll keep an eye out on this one, IFB Industries. Is it good for more? After seeing a halving of the share price from the top, we'll keep an eye out on this. Good delivery-based buying and some technical levels getting taken out as well.
Okay, all right. So let's straight away get to the action then. We have the equity call of the morning coming in. It's from Chetan Sheth of Nomura, who continues to believe that the extent, timing and scale of reciprocal tariffs will determine the outlook for Asian stocks. He says they have been cautious on Asia ex-Japan equities in general, but they continue to believe that they appear attractive for investors willing to look past near-term uncertainties, given recent underperformance, modest valuations and light foreign investor positioning, with a scenario of softer US dollar likely to bring some relief for Asian central banks to be able to embark on rate cuts to support local economies. He says a significant drawdown in Asian stocks on such tariff announcements might turn out to be the point of peak pessimism, where risk-reward becomes decisively more favorable for Asian equity investors to use those drawdowns as an opportunity to build longer-term positions. Buy the dip seems to be Nomura's view.
All right, Matt Orton is now with us, Chief Market Strategist at Raymond James Investment. Matt, good to have you with us here. Good morning. What do you think? Is it, or do we just don't know? As someone put it well last week, whatever comes on the 2nd of April, for India specifically, the hit is not direct because we're not a big trading partner with the US, one way or the other. The hit is indirect, which is not less painful or anything because of global growth. But let's just start with at the beginning? I mean, what is your sense? Is it going to be a big one? Is it going to be phased in?
Hey, good morning, Prashant. Always great to join. And I think we might still have a surprise on April 2nd. I've been telling clients while my long-term thesis with respect to growth and overall markets still remains fairly optimistic, I'm cautioning against leaning into the rallies that we're seeing globally, particularly if we see more of a relief rally in the US, simply because there's a lot that we still don't know. There's been so many starts and stops with respect to tariffs, it's really hard to believe a lot of the headlines that we're hearing from the administration. And I actually think that rather than reciprocal tariffs, which are very painstaking and difficult to put into place and are going to require more time, I think April 2nd is really going to be more about penalizing tariff villains or perceived tariff villains around the rest of the world. So I think India might be in store for perhaps some tariffs that get put in place. But to your point, I don't think it greatly will impact the Indian market. And so for me, what's a really important cue to look for is, can Indian markets continue to push higher in light of some tariff volatility? Whenever markets that are rebounding, if you can rebound through bad news, that to me is a very good confirmation that a bull market is starting to form again. So that's what I'm going to be paying attention to on April 2nd.
Okay, fair point, Matt. And we've seen some signs of that, right? Even when the US market was faltering, India managed to hold on pretty okay in the last 2 weeks or so. So, if you are willing to put some more money to work here in India, and let's say if there's no major disappointment in April 2, then what would you buy in this market?
Yeah, Surbhi, we've talked about a lot of the companies that I favor that I still really like. Higher quality investments that I've been leaning into, like ICICI Bank. I know this is one we talk about quite a lot, but it is, I think, one of the highest quality Indian assets. It's been able to see through some of the challenges with respect to loan growth. Its private banking business, I think, also provides a very good diversifier. So this is one, if you don't own, it's had a really big rally. So maybe look for a little bit of a pullback to add some exposure. But another bank that I have my eye on is HDFC. I've always liked their asset manager, but the bank itself, I think the market is a little bit too pessimistic on their ability to push through margin expansion. And again, I think the Indian consumer is in good shape, and especially with growth on the rebound, I think their ability to grow loans is underappreciated by the market. So I'd look into that. And another pullback I'd look for is Interglobe. This is a name I'm a little bit upset that I've missed. It's one that I've been looking at for a while, just given the operational efficiency of the management team, but their ability and their growth plans to hit 600 new aircraft by 2030, that's still well on target. Their ability to manage costs through large-scale orders, that is well in place. So that's another name that I view as high quality and leans into the idea that people are traveling more, the consumer's doing well, and as growth rebounds in India, I think this is one to look at on pullbacks.
All right. Hi, Matt. Morning. Always good to hear your thoughts. So what's the view on global equities, though? The US markets have seen some profit taking from the top. The European market has done very, very well. So in terms of developed markets, what do you like? And from the emerging market basket, you have liked, I think, LATAM, select parts of LATAM. China has done quite well as well. And India has underperformed. So when does India feature in the emerging market pecking order? Developed markets and emerging market. Go ahead, Matt.
Yeah, so I'll start first with developed markets, Nigel, because I think what I'm looking for is perhaps a little bit of a rebalance. Europe, I think, has outperformed significantly, and rightfully so, given that things have gone from really, really bad to perhaps looking better. And I think the fiscal stimulus you're seeing out of Germany has been necessary for so long, but it's not the only thing that matters. Europe still needs a weaker dollar. Europe still needs to find a way to better coordinate financing and giving money to businesses to actually form. So right now, I like global banks. I think leaning into banks in Europe and around the rest of the world makes sense. I think looking for pullbacks in European defense companies, that makes sense. And Japan, honestly, has been forgotten in the developed market perspective, but Japanese markets actually have the strongest earnings acceleration. And that to me is very, very important looking forward. So Japan, I think, looks very interesting from a global market perspective. On the emerging market side, India is finally bouncing. Like I said before, if we get confirmation and this rally continues past April 2nd, I think we're going to see a lot stronger gains going forward. So it's definitely one to keep on your radar. Latin America has done well. I think there's been some reforms put in place. I want to see again how April 2nd plays out, especially for markets like Brazil that do trade quite a bit with China, what that impact could be. But what I like about Latin America is that they do produce a lot of food. And in light of tariffs, their demand across the rest of the world, if there are tariffs or difficulties trading U.S. agriculture, they're going to benefit the most. So that's another region that I think can continue to perform well, especially commodities and agriculture, is they'll be the supplier to the rest of the world, maybe if the U.S. loses a little bit in the short term with respect to tariffs. But markets overall, I think, are in a good place. Don't chase, wait to be opportunistic, and hopefully in a few weeks we're going to see stability and maybe a little bit less volatility, which should help sentiment rebound.
All right, Matt, thank you very much. Always a good conversation, and appreciate your time here on CNBC TV 18. Well, let's quickly run you through what's lined up here over the next 2.5 hours or so. So 8:35, we get you an exclusive chat with Ramesh Damani on markets and macro trends as he's seeing them. 9 o'clock, we'll have Sumit Kumar of JM Financial Institutional Securities to discuss key trends in the real estate space. 9:20, Manishi Ray Chaudhary of Emmer Capital Partners. He's a market master. 9:30 in the morning, KEI Industries will be with us to discuss the impact of the Ultratech Cement and Adani Group's foray into the cable and wires space. Stocks last week did suffer once again. We have the management of BSE chatting to us from location at 9:40. There is a fair bit happening. It's almost cat and mouse between BSE and NSE with regards to expiry days. 9:50, some more market conversation. We'll play out more sound bites from Mr. Damani coming up. And towards the end of the program, we'll have Lata join us on It's the Economy in conversation with Sanjay Agarwal of AU Small Finance Bank. So lots lined up.
Well, time for a quick break, but we have a lot of stock-specific action to track today in our special Top 10 segment. For the time being, I'll run you through the list. We're looking at GSPL, GAIL, DLF, Godrej Properties, Hindustan Copper, Kotak Mahindra Bank, Power Mech Projects, Alembic Pharma, and EPAC Durable. All of them will be reacting to positive news flow, while UCO Bank will be the lone one that will be reacting to negative news flow. Take that mandatory break, come back. We'll get into further detail on all of these names.
Welcome back. Let's pull up the implied open again. It's slightly better than actually most of the regional markets around us, and that's because maybe it's latching on to the positivity from Wall Street futures, which are all up and about. The hope is that the 2nd April event is not going to be as catastrophic as the markets had originally thought. So therefore, there's some green that we're seeing. Let's see if it turns out to be indeed as good. But there are lots of interesting stocks worth keeping on your radar. So let's get to our team for the CNBC TV 18 list of top stocks to watch this Monday morning. Guys, morning to all of you. So Darshan, I'll start off with you. Is there some fresh development on, oil and gas tariffs or pipelines? But why are you watching out for these stocks?
So natural gas regulator, that is PNGRB, has put out a draft on its website, and this draft is of the certain changes that industry has requested. And on that, PNGRB has sought comments by April 11. Now on that, some of the brokerages have written note. First one is Citi. It says that major changes are fuel costs and that price of contractual LNG can now be claimed. And for this, GAIL can be the biggest beneficiary. Second change is less stringent volume assumptions once volumes cross 75% of the threshold. If it is done, then this can benefit GSPL. CLSA says regulations could lower operational expenditure for IGL and MGL. Also, it can GAIL and GSPL, if certain changes that have been requested by industry committee, if it's approved, that can benefit, and tariffs for GSPL and GAIL can increase. Also, there might be an increase in cost of gas users, including industrial customers of Gujarat Gas. So overall, if the changes are approved, it can be positive for GAIL, GSPL, MGL and IGL, and can be a bit minor negative for Gujarat Gas.
Okay, all right. Thanks a lot for that, Sudarshan. Well, let's hop across to Vinny. She's here to tell us about DLF. Morning, Vinny.
Good morning. So we're keeping an eye out on DLF because on Friday they had some analysts meet and met some of these analysts. Now, some positive commentary that is coming from the company. They expect these new sales booking are also expected to continue to remain healthy on these steady lines. And overall, in the next 5 years, they're planning to launch around 1,14,500 crore of new launches that is planned. Of this is the target that they've given previously, right? So of this, as of now, 35% has already been launched in this 9-month period of FY25 that we've seen. In FY26, 15% of this target also is what they're looking at will be launched in FY26. So interesting pipeline in terms of launch is what DLF has planned over the next few years. Now, other than that, even the annuity portfolio rentals are expected to cross 10,000 crores, which is twice the levels that we're watching out for as of now. So yes, in the next few years, doubling in terms of the annuity portfolio. They aim to achieve group net debt zero levels and positions by FY30, and this is something that they're focusing on in terms of payout ratio. 50% of the profit over a period of time is the target price. So that is why DLF, we are expecting a bit of a green here.
All right, Benny, let's stay with the real estate space and talk about Godrej Properties as well. Take it away.
So Godrej Properties, we're seeing that they've acquired a 10-acre land parcel. This is in Bangalore. So furthermore, expanding their position in Bangalore is what the company has been doing. This is around revenue potential 2,500 crore rupees. This will be focusing in terms of residential properties as well as some high street retail is what the company has highlighted as well. So a couple of things that will be happening here. Positive expected here as well.
Okay, all right. So buying a big chunk of land in Bengaluru. Got it, Vinny. Thank you very much. Let's bring in Hormaz. Hormaz, morning. You're watching out for Hindustan Copper and Kotak Mahindra Bank. What's happening?
Morning, Surbhi, and some change of guard taking place at both of these companies at the higher level. We'll start off with Hindustan Copper, where Sanjeev Kumar Singh, who is the director of mining, has assumed charge of the as chairman and managing director of the company, and he has been appointed for until June of 30th of 2026 or until further orders. And Ghanshyam Sharma, who is ceased to hold the additional charge of post of chairman and MD, who was in the post until then, but he will continue as a finance director and CFO of the company as well. So Hindustan Copper should be on your radar, as well as Kotak Mahindra Bank, who has elevated Bhavnesh Lathia as the new Chief Technology Officer, and he's been the Chief of Customer Experience and Head of Technology in Consumer Banking since August of 2022 at the bank, and he has over 27 years of experience in global technology products and platform management among key services. So both change of guard coming in at Hindustan Copper and Kotak Mahindra Bank. Expect some green there as well.
Okay, all right, Hormaz, always on the ball, but Hormaz, final one on UCO Bank. What's the news flow there?
Welcome back to you, Nigel. But yeah, UCO Bank, in line with most of the PSU banks launching QIPs, we saw Indian Overseas Bank launching one. UCO Bank too, a 2,000 crore rupee QIP is where they have launched a floor price of 36.07, an issue price of 34.27, which is a 9% discount to Friday's close. And it is one of those few PSU banks where the government shareholding is in excess of 90%, 95.4 to be precise, as of the December quarter. And the stock already from its 52-week high is down almost 40%. So some supply coming in terms of the QIP. Expect some red tick there as well.
Okay, all right, Hormaz, got it. Thank you very much for that. Let's go to Vivek. He's watching out for a bunch of other names as well this morning. Vivek, morning to you.
Well, good morning. Quite a few stocks on the radar on the back of news flow. First on the list is Power Mech Projects. They received quite a large order, almost 579 crore worth of order wins that the company has received from BHEL. This particular order pertains to construction of civil, structural as well as architectural works, and this particular order pertains to the 2 into 800 megawatt thermal power plant at Jharkhand. Remember, the order book at the end of Q3 FY25 stood at over 57,900 crores. Alembic Pharmaceuticals is the other stock on the radar. A positive conclusion as far as the US FDA inspection of the API 3 facility at Karakhadi is concerned. It was a scheduled good manufacturing practice inspection. Company completed the all of the inspections. Form 483 did not have any observations. So some positive news are coming for Alembic. EPAC Durables is the other stock on the radar. The company has gone ahead and received the approval for getting the disbursement of the second incentive under the PLI scheme for white goods. Now, the total quantum of this particular incentive that the company is expected to receive is 30 crore rupees. So again, some positive news are coming in for EPAC Durables as well.
Okay, all right. Thanks, Vivek, very much for that. Let's quickly recap our list of stocks to watch. The ones that have positive news flow around them this morning are JSPL, GAIL, DLF, Godrej Properties, Hindustan Copper, Kotak Mahindra Bank, Power Mech Projects, Alembic Pharma and EPAC Durables. The only stock that has some negative news flow around it is UCO Bank, and that's because of the impending fundraise. All right, let's now shift focus to commodities as well. We have Manisha Gupta joining in with a roundup of all the latest action. Manisha, good morning, good Monday morning to you. So while we await all the details on tariffs, over the next couple of days, what are you watching out for today?
Well, yes. So some profit-taking finally coming in, and that is because the dollar index is now trading at a two-week high. That has led to some decline coming into the market. In any case, you had COMEX holding at record highs when it comes to gold holdings. Copper almost hit a record highs in the previous week. So there is some bit of a decline coming in here. But as markets are looking at geopolitical tensions, tariff concerns, we are also looking at Iran sanctions coming up. OPEC also looking to increase production going forward is what really seems to be putting crude oil prices under slight pressure. When it comes to metal prices, as I said, copper did hit an all-time high in the previous week. So this is one metal that continues to outperform, up 28% in this year until now. But we have seen, while the base metal prices are trading up, the ferrous metals have seen a bit of a profit-taking coming in. You have steel, iron ore prices in China trading at a two-month lows right now. So even as the Chinese government has talked about cutting production, but when you look at the housing investment, that has been lower to multi-month lows. Markets also are still awaiting for stimulus measures coming in from China. Until that comes, you could be looking at further pressure coming in for ferrous metals.
All right. Thank you very much, Manisha, for that. So it's metals and commodities in focus. Well, we'll take a quick commercial break here. We're going to come back, Prakash Devan, on stocks and what to watch out for as we start this Monday morning.
Welcome back. You're tuned into Bazaar Morning Call and hope you're having a good morning. For starters, the GIFT Nifty suggesting that the implied opening will be higher by close to around 80 to around 90 points or thereabouts. So that's going to be good, 100 points, so essentially to kickstart trade. Prakash Devan, our market expert, joins us on the show. Hi, Prakash. Well, the market seemed to have got its mojo back, and we didn't mention this earlier, but today marks 5 years of those COVID lows when we visited around 7,500. And boy, oh boy, today we are at 23,000 odd. So the market itself has moved up by close to around 3x. We have stocks that are in fact at up 1,000, 2,000, 5,000, 11,000% as well in these last 5 years. So it's been a big rally. But let's talk about the recent past. We've seen that stocks have done quite well. Any one particular stock that you believe that still has potential from here on? The last time around you spoke about Welspun Corp. You'd spoken about Nalco as well. Both of them have bounced off their recent lows. What's on your radar this time around?
Good morning, Nigel. Great to see you back. So I think, the market's kind of very clearly ripening for some sort of value discovery through a sector rotation framework. And if you look at the recent moves, some of the stocks like Interglobe Aviation, which I spoke about while you were away, it's something that's been so resilient even in this entire downfall. And thanks to the softness in crude, thanks to the improvement in pricing power, load factors, whatever have you, it's kind of bounced back and made new highs. What's going to happen is this is going to continue to other names in the sector, other subsectors within that. So let's say hotels. I think if you ask me one stock that I see as very well poised in terms of fundamentals and the technical demand supply, it's ITC Hotels. It's absolutely a no-brainer because given the asset base, given the kind of revenue build-up that you've seen after, which you potentially will see after it kind of starts reporting its standalone numbers. It's made an amazing move in the recent past, but I think there's much more to come. The ownership levels are far lower than what a large hotel business, the second largest hotel business in India would need. So, once ETF money starts coming back, well, as and when it happens, I'm not sure whether it happens 3 months down the line, 6 months down the line, but these are stocks that you need to kind of build on your portfolio. And yeah, you spoke about metals. I think metals is a phenomenal rally in the making, even ferrous, not just non-ferrous, so the likes of Vedanta, Hindalco, Nalco, even Hindustan Copper for that matter. I mean, it's in the news for some change in leadership, but I think globally the setup seems to be the same. But everybody's waiting for this 2nd April this thing to go, overhang to go. Once there is clarity, I think things will start looking up on the metal side as well.
Okay, all right. Morning. Good to have you, Prakash, with us. You know, a lot of these construction companies, not just construction EPC, but even other companies, order wins have been coming in. Kalpatru, this morning we're looking at names like NCC, Power Mech, etc. So basically, everybody is getting orders, whether you're in road EPC or transmission, etc. What are you most optimistic on? This is also your end of year phenomena, obviously, or people have to finish their spends, adjust their books. But what would you buy, if anything?
Good morning, Surabhi. So, you're right. While March end kind of typically seems to be a phase where, a lot of these bundling up happens to meet the deadlines. But remember, the government's spend, as articulated in the budget in Feb, is something which will start coming into effect 1st April onwards. And this is one sector that would probably seem very resilient from a sector perspective. You may not have tariff impacts impacting it so much. You may not have issues related to capital costs given the softening of interest rates. My sense is EPC names, and especially a lot of turnkey EPC, is something which will start making some money for investors. You'll be surprised, while L&T is the poster child of this sector, you have NCC, which is the second largest order book currently available. And the beauty is that they've started diversifying beyond the Telangana, Andhra belt. It's much more wider, much more complex in terms of the orders that they're taking. So, and a great balance sheet to boot. So it's very well poised to take on. Most of the good companies, most of the larger EPC players are. But as a sector, it doesn't give you that kind of thing, because the moment something goes wrong in terms of capital expenditure, either from the private sector or the government side, or there's some sort of a slowdown or a blip, these companies get impacted the first. So you'll have to be a bit careful selecting that. But I think from the current situation, if I look at NCC, definitely, not just because it's in the news today, but even as I said, it has the second largest order book, fairly juicy orders, good margin profiles. If you aggregate all of that, it definitely does make for a little bit of a presence in the portfolio. But of course, you'll have to see the risk reward that it comes with being an EPC play.
Okay, all right, Prakash, stay with us. Surabhi, I wanted to ask you, you had a chat over the weekend, I think so, on, with one of the best voices to hear on the market, Mr. Ramesh Damani as well. Tell us more about that chat, and I can't wait to listen to snippets of it, but give us your brief, takeaways.
Well, this is part of Market Cafe, so we thought, we'll start the second season of the series, and who better than Mr. Damani, who kind of was gracious enough to give us some time. And usually these are longer-term conversations about bigger cycles, and we sat down to try and understand the impact of Trump 2.0 longer-term on markets, whether anything is changing for us as investors. But if you have him, then you have to ask about current markets as well. Sneak in some questions, right? So Mr. Damani is actually fairly optimistic. And he said in this conversation that the bull run has actually resumed. And unlike a lot of us, when we are constantly looking at these FPI flows on a day in, day out basis, he says he's not very worried about them at all. He doesn't, pay too much attention to FPI flows. Here's why.
What happened in 2024 with the election of Donald Trump is that the world is not going left or right, but America is turning inward for the first time. And that has profound changes in the world, because whether we like it or not, America is the most important, most significant player in the world today, whether politically or economically. But the fact that they were turning inward meant the world would be a very different place. So while I keep hoping that the past is prologue, that what happened in the 40 years that gave us so much prosperity and peace and, a good standard of living will continue, I feel that the world is about to change. And I think as investors, we have to be the first to notice that.
So it's not so much about left, right, or center. It's not so much about your, political stance. It's more about whether you are inward or outward looking, from what you're saying, whether you're integrated. And that's under cloud. I mean, the whole globalization era and that boom, that itself is under a bit of a question mark in this new world that we're in, right?
The good news is, the bad news is that, yes, it's under a cloud right now. It's under a very serious cloud. That's why I told you the axis was changed. The good news that is my personal belief and my personal call that these are irreversible changes, that you could delay globalization by another 3 years or 4 years. I doubt if it's even that long. You can delay a world where, the strong prey on the poor, which is what is happening now with the spheres of influence, as Donald Trump is calling it. that Russia controls Europe, we control North America and South America, and China controls Asia. So all that is being questioned as we speak right now. But I think it will delay globalization, it will delay international system. It cannot deny it because the human arc works towards progress. And it's very hard for me to believe that we will go back to a mercantilist policy, a tariff-based policy, as Trump is advocating. Either he will change or democracy and the people's aspirations will force him to change. So while we are going through a very difficult period right now for the global economy, I don't think it's going to be the lasting change in the world. The lasting change is towards free markets, prosperity, trading.
Is US exceptionalism, for the time being at least, is it ending? Do you see the US market topping out?
I think Donald Trump and his MAGA crowd are going to learn a very hard lesson in economics. See, this is what he's trying to do if you try to sort out all the madness and see what the Colonel is trying to do. He believes that American manufacturing has been hollowed out. You know, America imports almost all its critical stuff other than technology from China, from Vietnam, from Philippines, from India, from other countries in the world. So this is what they've done. They first reduced the tax rates in America. They made the corporate tax rate 15% or so. They're job-owning the Fed to cut the interest rates. And they're building tariffs so that domestic industry can do well. So they want to bring back manufacturing and manufacturing jobs. That is the constituency that elected Donald Trump to America. Now, unfortunately,
it may not even be most cost-effective, which is the debate
it is
raging right now.
It is absolutely not. And that's the whole point I'm making, that when economics meet reality, economics is going to win. You know, it's just, you know, it's like when the Titanic hit the iceberg won. So economic reality is economic reality. You can't make jobs in America or pay people in terms of inflation when the same product will be available for 30-40% cheaper if you import it. It goes back to what Adam Smith said about specialization in the world. I think America, for all the leadership and intellectual leadership it's shown to the world, is losing that moral supremacy that it had in the world as the one superpower in the world, the one defender of democracy.
That's sort of getting me to the next question. So if you're saying that for the time being, maybe there are some speed breaks on the whole American equity story. What we've seen in the past, well, the last many, many years, that every time they say, you know, America, sneezes, the world catches a cold. So if that were to play out, and let's say the American economy starts slowing down, American equity market starts faltering, in the past, we've seen everybody falls. Could it be different this time?
No, we will falter. I mean, there's no doubt about it that America is such a big, important economy that America squeezes the rest of the world, catching the cold. It's very true, particularly in emerging markets. But I personally feel that given that these are now considered permanent changes in the world. So you see what's happening in the world. China, India, Russia created their own trading bloc called BRICS. France has already made a declaration that it would now be the nuclear armament of Europe. So these are important changes in the world. So if America wants to go backward, the world will move on. The world will figure out different alliances, different prospects to take. And no doubt that they will move on. It is to America's detriment to realize that they were the centrifuge force in the world, and they are relinquishing the space.
Aside of India, just for a second, if I were to ask you, which is the other market that you would like? Maybe you will take exposure, maybe not, but a market where you see there's serious potential outside of India.
I mean, I haven't, to be honest, the only two markets that focus are India and America.
US,
the most important markets screen. But just going through the data, I would say Europe would already be starting a bull run, which is then I can't understand coming.
A European bull market.
Or European bull market when it's facing the moment of crisis. But you remember in 1991, India faced this moment of crisis. And the index was below 1,000 there. Now, sometimes bull markets are born out of that.
Out of crisis. So that's Mr. Damani. Okay, that's a different part of the conversation than what we had originally intended to play out. But this is where he's really talking about how these are tectonic, seminal changes. And when asked which would be his favorite global market aside of India, he actually calls out Europe because what's happening there is something you simply cannot ignore. More coming on the Indian market from Mr. Damani in just a bit. And of course, this is the next season, season 2 of Market Cafe. You can catch that entire conversation as we get towards the end of the week. Well, for the time being, it's back to the here and now. Now, the market has bounced back from lows, with the Nifty registering its best week since February 2021. Prashant is putting some context to these numbers. Great comeback, Prashant, for the market.
Absolutely. And, the market sniffs out changes. As they say, it's the collective, right? And the collective usually senses what is coming in, what has happened, and what is ahead as well, more often than not. So this is what we've done. And I think as we start this new week, ahead of this tariff deadline, etc., it's important to just look at where we've come so far. And what I've done is I've just looked at how much we've come off the lows. The low was made on the 3rd or the 4th of March, if you look at, depending on what you look at. But more importantly, I've also looked at where we are from the top. So the Nifty is bound 6, it's about 11% away from the high. Nifty Bank is bound 6, about 7% away. Mid-cap index is bounced 10.5, 15% away, 13% bounce for the small cap, 18% away from the highs. This next graphic kind of just looking at history, and this came to us from Novama. And, just kind of sometimes looking at history gives you a sense of that, well, this has happened before. It's not unusual. It does happen with, a fairly, it's a frequent thing. And in this case, it's a 2-year cycle. So look at this. 2016, Brexit, 23% fall for the Nifty. ILNFS, 15% fall. COVID, Russia, Ukraine tariffs. Well, the last one, of course, which is this one, from the high to the low, the Nifty lost about 16%. We've regained about 6% of this fall. Let's move on, look at sectors, similar kind of numbers, how much we've bounced, how much we're away. This is, of course, sorted from sectors which have bounced the most. Metals comes right on top as the dollar index has sold off. 16% bounce from the lows, 10.5% from the highs. The CPSE index, which was the first to start to sell off aggressively, is bounced 15%, but still 20.5% from the highs. Oil and gas, again, a lot of PSU here. And of course, there's Reliance as well, 12.5 bounce to 23% away. Real estate, again, big casualty, 10% bounce, 25% away. Stocks have really taken it hard. And then you got the PSU Bank, the Pharma Index, 10 off the lows and 10 off the highs. And look at these three sectors. Autos, not very much at all, right? 9% bounce, but 21% away. That's a large space. FMCG started falling, of course, much before. It didn't really perform with the rest of the market in a meaningful way. Just a 6% bounce, 20% away, and the IT index is still pretty much at the lows that we've seen. Just look at stocks if you can quickly move along. And these are the NSE 500 stocks, the group that I've used. The low is as of the close of the 3rd of March, and I found 40 stocks which have bounced over 20% from the 3rd of March close. Just a sampling, right? A lot of the defense names, basically a lot of manufacturing, industrial, capital good names. Kirloskar, NLC, Welspun, JSW Infra, KEC International. Capital markets, another theme, 20% plus bounces, K-Fintech, Novama, CAMS. There is, of course, DOMS, Amber and Spark, which come up as well as bounces that we've seen. Stuff which remains beaten down, but to put this in context, these are not names which started falling when the market started falling. They've been falling for some time. But Devyani, Sapphire, all consumer names, Metro, Vedant Fashions, Campus Activewear are names which still remain pretty much at lows. Small bounces, MapMy India, a lot of the IT names, Infosys, LTI Mindtree, Wipro. And of course, I just leave with these two last names, Indocent and KEI. KEI management joins us a little later today as well. But these are news related in terms of what we've seen come through over the last few weeks or so. I mean, that's the picture. A very smart bounce, but some numbers and some context to that bounce as we've seen so far. What we'll do is we'll take a quick commercial break here. We'll come back. Prakash, of course, is with us, but we'll also get our technical experts joining in with some here and now trading ideas. Stay tuned.
Welcome back. Let's now get a quick technical perspective on the market, figure out some trading ideas as well. We've had a great pullback and rebound last week. Will it continue? Mitesh Thakkar and Sudarshan Sakhani are with us. Gentlemen, good morning and a happy Monday to all of you. It is a happy Monday, right? Because the indices between Nifty, Bank Nifty, Mid-Cap, The pullback last week was between 4% to 8% on the small cap index. So lots of momentum. So let's find out how are you approaching it right now. Mitesh, I'll go with you first.
Good morning, sir. So, I have been talking about targets around 23, 550, 600 on the Nifty. And we might be very close to achieving them. In case we clear that, I think 23, 750 is the next level which I'm watching. Similarly, on the Bank Nifty, the first target of 50,500 was cleared on Friday, and 51,600, 700 next target area. So both the indices, despite a very good rally and a very good week, still suggest that there are more upsides which are left. What can happen is that, yes, you can get an intraday decline or a profit booking kind of a pullback. But I would believe that the directional bias in the short term is on the upside. So all declines would be.
Fix your feed. I think that's a line that's freezing up. Allow us a minute. Let me ask Sudarshan that question as well. Sudarshan, so playing on the long side for this week, what are the levels also, both Nifty and Bank Nifty? How to do this?
Yeah, good morning. See, we have been on the long side when the markets crossed 22,000. It's been a dream run. I think most traders who have got this, the traders who have got this up move have actually made money, which is 1 year's money in 20 days. It was so good. There was never a pause. There was never a sense that this uptrend is going to sort of get an ending or do anything else. Nothing. That continues. Now the markets will pause at some time, will stop this up move, but it's not today. We don't have any message from the market that it's willing to stop. And this actually becomes, very terrifying for most traders who have put targets, who have said, okay, this market will go to 22,500, 22,700, and now they see it going 1,000 points higher. So if you are in this market, stay long. If you are not, buy every small dip intraday to go long. You can't in the market and say, okay, you can't go higher. We don't know, it could. So the trade is buy every dip.
Buy every dip is the trade. Okay, got it. Stay on, gentlemen. We'll come back in just a minute, take a quick break, come back with some of the trading ideas that one can work with today. Also, Sumit Kumar, real estate research analyst at JM Financial Institutional Securities, is going to be joining in to talk about trends in the real estate sector. Welcome back. You're with us on Bazaar Open Exchange, and of course we're coming to you from the CNBC-TV18 Motilal Oswal studios. Let's quickly get to the stock ideas that you can work with this morning. We've got Mitesh and Sudarshan both with us. So let's quickly come to the stocks now. Mitesh?
Yeah. I have all buy calls in line with my market outlook. So a buy on Indus Towers with a stop at 341 for targets of 365. Coal India managed to clear important weekly averages, so that's a buy. Keep a stop at 398. Look for targets of 420. IEX is a buy with a stop at 170 for targets of 178. And IRFC is a buy with a stop at 127 for targets of 137.
Okay, all right. So those are individual kind of trading ideas which are coming through. Sudarshan, what about you?
Yeah, good morning. See, one of them is the same as Mitesh. I also have a buy on Indus Towers with a stop at 342, roughly the same stop. Ipca Labs is a buy with a stop under 1393. Tata Elxsi is a buying opportunity, the stop under 53.55. Another IT stock, Vedrasoft, Vsoft, is a buy with a stop under 397. There is a theme that seems to be the undercurrent is that after the large caps, the small and the mid caps are now slowly picking up. So it's a good idea to focus on them.
Okay, all right. Thanks very much for that. Those are trading ideas. We'll speak again. There's a minute to go as far as the pre-open is concerned, 9 o'clock. L&T is the next one that we're going to focus on. And Vivek is telling us why. Large bids, apparently, for a very large order. Vivek, tell us more.
Well, good morning. Well, this is what we are picking up from reports, and these reports are from Middle East Infrastructure Journal. So, what the reports are indicating is that L&T has likely emerged as the winning bidder, and this is for a project. It's a very large project. Close to $4 to $4.5 billion of spend is what is expected for this particular project, and this project is from Qatar Energy. Remember, Qatar Energy is currently increasing its current LNG capacity from 70 metric tons per year to 126 metric tons per year, and this particular bid is for a project for expansion of North Field as well as the South Expansion project. Now, we understand that L&T has gone ahead and emerged as the winning bid, and the total size of this bid, even if you take the lower end of the range, is close to $4 billion, slightly northwards of 30,000 crore, one of the largest order wins that L&T could witness. Now, a couple of things that we need to keep in mind. Number one, what was the winning bid of L&T, and what is the size of that particular bid? Also, what will be the scope of work as far as L&T is concerned, and whether they get the complete order package. In certain cases, we do see that the packages are split into multiple components. Remember, we reached out to L&T. L&T did not offer us any comments at this point of time, but we understand that this particular order win, given that it has come in before FY25, likely to be booked within FY25 itself. So in the next, till March 31st, you could hear some development coming in from L&T as far as this particular bid is concerned. At the end of Q3, the order book of L&T was 5.46 lakh crore, almost 20% year-on-year growth, and the company had given an order inflow guidance of close to 10%. Company very well poised to go ahead and significantly beat the order inflow guidance that they had given at the start of the year. Watch out for L&T. This is a significant development.
All right, Vivek, thank you very much for that. So L&T should be in focus, but let's ask Prakash as well. Prakash, you heard Vivek outline the news around this one. What do you think?
Prashant, irrespective of this news, I think L&T stands to be one of the best beneficiaries of globalization on the infrastructure side. The other thing I just want to add, because we don't have much time, the difference between the L&T of the past and the current and the future L&T is that they can cherry pick orders or contracts where they make very juicy margins, which was never the case in the last decade. So you'll have a very different margin profile emerging out of this 5.5 lakh crore odd book. And that's the beauty, because they're spoiled for choice given their expertise and salience. So definitely something which in the near to or the long term would benefit tremendously in terms of outperforming the broader markets.
Prakash, if you can have those graphics, and by the way, I think you were on closing when I put those numbers up, the bounce, etc. One particular, if you can pull the capital market plate up, KFin Tech and the other ones which have bounced nicely, Novama, etc. Any thoughts on this space? We have the BSE management come up a little later at about 9:40. Will be interesting. That's another one. That's another name where we've seen a fair bit of re-rating, a fair bit of sell-off from the top as well, and now a bit of a bounce. What do you think, Prakash? What's your favorite idea, rather?
Yeah, no, so from that universe, if you look at the broking houses are going to find it extremely difficult to continue growing, and the base effect will start going against them at some point in time. Right? But it's businesses like KFin Tech, CAMS, which continue to kind of, grow as AUMs grow, as new dematerialization comes into picture, and there's a lot of work on the back end. But I like KFin Tech given its propensity to diversify beyond the domestic market. They've made some very good inroads. The new plan that they have, the program that they've launched for Southeast Asian funds is something which could kind of pave the way for a very different revenue stream. So a bit, soft at this point in time. All of them, whether it's broking, whether it's the depositories or the, brokerages or the exchanges itself. But till the NSE IPO happens, Prashant, this is going to be, there's not much of fireworks that you would expect. But I believe that's kind of, getting to be, people are getting excited as progressively steps are being taken towards that particular large event. But till then, I would probably only look at a KFin Tech.
Okay, all right, Prakash Devan, thank you very much for being with us. It's good to get some of that context and that perspective. We will chat again soon. We have with us Sumit Kumar, real estate research analyst at JM Financial Institutional Securities, joining in for a quick chat. Sumit, we'll come to some of the registration numbers out of Mumbai in just a bit and your overall views. But I want to start with DLF because on Friday they had this analyst call. I'm guessing you must have sort of also participated, or you would have gathered your inputs. Anything new that came out of it?
First of all, good morning to the team and good morning to all viewers on the show. I think no major surprises in the DLF analyst meet. They highlighted the recent performance and outlined the growth plans for both the businesses, the residential and the annuity piece. In the residential business, they intend to sort of maintain that same pre-sales rate close to around say 210 billion, which they will be achieving in FY25. And in the annuity side, they expect to grow their rentals almost 2 times from their current exit run rate of 50 billion to around 100 billion. So these things were already known, no surprises, and I think over the next 3-4 years, there is a significant amount of cash inflow into the company, which is basically 5,000 plus crores of rentals. You make almost 80-85% margins on that. And obviously, they've sold roughly close to 300 billion of inventory in the last 15 months, 4-5 quarters. So all of that, a large part of it is already sold. They just need to execute and collect, and hence, the cash flow position, the balance sheet looks extremely robust and healthy. And we do have a sort of constructive view on the name.
Okay, so constructive on DLF. Got that. There's been some chatter about whether the fact that the equity market cooled off, and now it's revived again, so these things turn very quickly, but there was some chatter that this cool off in equities, whether that will put a bit of a dampener on premium housing, especially in very hot markets like NCR or Mumbai. Did you pick up any evidence of that at all in the last 1 or 2 quarters?
So yeah, there is a wealth effect to to real estate where people sort of go towards physicalization of their savings and wealth. That is a trend, but at least in the last 3-4 quarters, or in fact in Q4, what we've seen is there is no let up in demand. I would say the hyperactivity, the speculative activity, euphoria has died down a bit, and that has been because of price growth has moderated. In my view, volume of take or absorption at all good launches, major launches by grade A listed developers have seen a good response. There have been a number of launches in Gurugram itself in the last quarter, in Sector 31 and Sector 54. There has been one launch in Sector 44 in Noida as well. What we have seen is that during the EOI process, the subscriptions were like 2 times, 3 times in FY24, last part of FY24. These EOIs were getting subscribed massively. That subscription levels have come down to reasonable levels. It's now like a 1.25, 1.5 times. And the developers end up selling 75-80% of the sales of the inventory that is open up for sale. So there are no sellouts right now. Price growth has moderated a bit, and that's actually good for the sector, if you ask me, because we don't want to get into a uncomfortable territory where prices are rising rapidly and sharply. But because that brings in speculative activity, and also, the end users actually take a backseat because of that. So I think it's looking healthy. Volume offtake remains robust. Pricing growth has moderated from, say, 11% in FY23 and 16%.
Sorry, if I can just... Sumit, hi, if I can just come in.
Reasonable levels.
Yeah. Sorry, if I can just come in. What are your top sort of published top 2-3 ideas?
So definitely in the residential segment, we would like to back, the people with a track record and a brand name. We like DLF and Macrotech in this space.
Okay.
And on the office side, we would prefer Embassy Office Parks as, our top pick there.
All right, Sumit, we'll chat again. Thank you very much. Short on time, just running into market open. 6 minutes away. Let's quickly get you the 9-10 calls as well. Sudarshan and Mitesh are back with us. Sudarshan, what do you have?
Well, consider buying Tata Elxsi. Tata Elxsi is a buy with a stop under 53.55.
Mitesh, what about you?
I'll go with the buy on IRXC for targets of 137.
Okay, all right. So those are trades which are coming through from both Mitesh and Sudarshan. IRFC up on your screen as well. HCL Tech, let's just put the spotlight on a few names now. HCL Tech is one. Rima is here to tell us more. Rima, morning.
Hi, good morning. So CLSA today has upgraded HCL Tech to an outperform from a whole rating. Their target price stands at 1,811, which is a 16% upside from current level. Now, CLSA says that HCL Tech has been one of the fastest growing IT companies in FY24 and FY25. And in all likelihood, the company is likely to have a podium finish in terms of revenue growth, even in FY26. So it's still going to be the fastest growing IT company next year. They also said that the company has managed to close the valuation gap with TCS despite having lower profitability. Remember, HCL Tech operates at lower margins versus TCS, and that's because the company has been focusing on increasing the the FCF free cash flow yield. The dividend payout has also gone up. CLSA, though, is assigning a 10% discount to HCL Tech vis-a-vis TCS. They've lowered the valuation multiple, given the correction that we've seen in the stock price. But there is an upgrade, and the target price at 1,811 is a 16% upside from current levels. Back to you.
All right. Thank you very much, Rima, for that. So we'll see how much higher HCL Tech gets. There's an upgrade, as Rima points out. City gas distribution companies are the next set we want to put the spotlight on. Sudarshan is here with reasons. Sud, morning.
Morning, Prashant. So it's for all the city gas companies as well as other gas companies, because PNGRB has put out a draft of certain changes that it's been planning in natural gas tariff regulations, and PNGRB has sought comment by April 11. On that, some of the brokerages have written notes. First one is Citi. It says major changes are: first, fuel cost, price of contractual LNG can now be claimed, and because of this, GAIL can be the biggest beneficiary. Second, less stringent volume assumptions once total volumes cross 75% of the threshold, which can benefit GSPL. CLSA says regulations could lower operational expenditure for city gas companies like IGL and MGL. Also, GSPL and GAIL, after the changes can be implemented, tariffs for GSPL and GAIL can increase and can be positive for these two companies. Also, there might be a hike in cost of gas users, including industrial customers of Gujarat Gas, so that can be minor negative for Gujarat Gas.
I got that. I think Mitesh is still with us. Mitesh, out of these names, I mean, HCL Tech, the city gas companies, MGL, IGL, etc., anything comes up?
Prashant, HCL Tech is oversold but yet to give a reversal. In fact, that's the case with the entire IT pack, though I suspect with the markets picking up so strongly, some kind of short covering and bounce back is due there as well. But for the time being, there are other stuff which interest me compared to the IT pack. So in the short term, I might avoid them. And on the city gas distribution pack, IGL, it's already started a move from 175 to now at about 197, 200 zones. 205 is a pivot, but I think once it crosses that, you might even see 220 over here. That's quite positive. And MGL is also, just on the breakout above its weekly averages. So if it can sustain above these levels of 1400, I would look at even a target of around 1480 to about 1490 on the upside.
Okay, all right. The other one is, just if you could briefly look at it, Chennai Petro, which had a very nice bounce last week. 30%, I mean, actually from the lows, it's up 30%. That's Chennai Petro. Mitesh?
CPCL, I think, it's a stock. In fact, the entire refinery pack has done well in the last few weeks, and CPCL has also done equally well. Sustaining or getting past 600 was a good event in the short to medium term charts, and I think now I'm looking at a slightly positional target of around 750.
Welspun Corp, if you can put it up into pre-open where it is left off. Again, it's one of those relative outperformers. It didn't correct at all like the rest of the market, and it's now come up very nicely. And Friday evening, we broke the story that the Welspun promoters are looking to get out of the warehousing business, and that's a large business, and bids have been received. So about 0.50 points. Friday, of course, the stock saw a large move. 884 or so is where Welspun Corp is at. I think we're just a few seconds away. Mitesh, thank you very much for joining us, and we'll come back to you with more questions a little later. But let's just look at the Nifty. the Nifty Bank and where we left off. 165 higher on the Nifty. Oh boy, I mean, this is a strong start once again. The Nifty Bank is up 400 points. So very, very quickly, I mean, you're past the first resistance level, which is, the 22,500 of 23,500 odd levels. And yeah, I mean, okay, not quite there, 23,490. So, but yeah, 23,500 almost there on the board. At least the pre-open showed us that. That's the first resistance. And then, of course, you start looking at retracements. The first one at 23,600. The 38% retracement to the entire fall. But you're right at the first resistance this morning. 0.5% higher on the Nifty. The Nifty Bank is up 0.5%. So super solid. And a continuation of what we saw last week. Mid-cap index is up about 0.8%. The Nifty heat map coming up on your screens will give you a sense of how we're starting. It's mostly in the green. You've got 41 names higher and about 9 stocks which are lower to begin the day. Surabhi.
Absolutely. What a solid start this is. The market now taking the next aim at the 100-day moving average, which comes in around 23,520 thereabouts. So let's see if we get to those levels. Right now, L&T, NTPC, Power Grid, Coal India. So lots of so-called old economy facing names doing really well this morning. Reliance is adding good support for the market. All the financials and banks are looking good. Kotak Mahindra Bank is up and about. There's Axis Bank that's flashing a fair bit of green as well, about 1% up. SBI is up about 0.8%. ICICI Bank 0.5%. HDFC Bank 0.5%. And for a change, actually, IT is not playing spoil sport. There's some green on IT as well. Infosys just about 0.25%. TCS is about 0.5% higher. HCL Tech is 1.5% up. So banks and IT both contributing. Other large stocks like Reliance also contributing. So it's a solid looking screen. In fact, if I talk about the losers, so to speak, not too many names. There's Trent, there's Titan, some profit taking or some weakness on these names, but otherwise it's good. Mid-caps is where the action really is. Look at the list of mid-cap gainers. A lot of these oil and gas stocks like Sudarshan had alerted us right in the morning because the PNGRB is looking at some consultations around some tariff regulations with respect to pipeline tariffs. So GAIL is one stock that's flying away, 5.5% higher. Even IGL is up and about. GSPL is up about 3.5%. So these could be beneficiaries and they're looking very, very good. Other newsmakers include a Power Mech, which announced an order win, 6.5% up on that stock as well. So looking good there as well. So the mid-cap screen is alive and kicking. Lots of names, Phenolix Industries, Senco, lots of names on the upside. 1% higher now on the mid-cap index.
It's certainly a good-looking screen and, a continuation of what we've seen last week. So, we'll just have to see the cash market, buying has to sustain, buying has to come back and then stay, because I think it just in terms of pure covering, short covering on both index options and index futures, I mean, that largely has played out. I mean, actually, we put those numbers up last week. At the total quantity of shorts, both on options and index futures, have been cut in exactly half, or maybe a little more even. So, that leg is played out. And now you've got to have cash buying, which needs to show up as well. And it has been showing up, at least I think 3 days in a row now. IFIs have been net cash buyers. Just a few other names, right? I mean, and think even in stocks, I see a little bit of continuation. GAIL is up. The biggest volume-led gainer this morning is GAIL with a 5.5% gain, 185 on GAIL. And of course, IGL is a number 2 spot, 4.5% higher. There is a name like Balu Forge, which is coming up with a 5.5% pop. And the only reason we don't talk about it, not in the first hour anyway, but it's coming up because it's at number 3 position with regards to volumes. Almost 500,000 shares traded with just a few minutes in, couple of minutes in. RailTel is up 4%. K Fintech has been a big recovery. It was up on my plate with the biggest bounces. K Fintech is up another 5%. Power Mesh is up 6.5%. 23.10 or so. Olectra is up 3%, and all these have got decent volumes. Phenolix Pipes is another one, 8% gain, coming off very, very depressed. It's not seen a big bounce at all, like some of the other names, but this morning it's up 8% on large volumes. So yeah, I mean, things are just about picking up. AstraZeneca is another one which is up about 6%. It's got almost 9,000 rupee name. EPAC Durables is up 5%. Stocks at about 375. There is Midhani, which is up about 5%. Nibe India, which is a defense name. I think Nibe used to be sometime back SME name, is transited to main board, but 4.5-5% has seen a sharp correction from 1,700 rupee levels to above 900, back above 900 now. So, yeah, I mean, there's a fair bit happening. On the downside, there is KEC, which is down 2.5%. It's got volumes as well. Mankind is up 2.5%. There is DAM Capital, which is down about 2%. But that's it. I mean, there are more names with cuts, but no volumes apart from what I've mentioned. So mostly all of the volume is on the upside. 10:1 is the advance to decline ratio coming in. Manishi Ray Chaudhary is with us, Chief Executive Officer at Emma Capital Partners. Manishi, good morning. Good to have you with us here. Thanks very much for your time. So, give us a strong view, Manishi. Bull market chalu or I'm just joking. But we've seen a nice bounce, right, Manishi? Yeah. And it's much needed air in the room. So people were gasping, and I think that's good. But what from here, in your opinion? As some have said, that this year is like it's going to be like W. I mean, sharp up, turns higher, sharp turns down, and so on, and so it'll go. Or do you think, as I think Ramesh Damani, and we'll play a soundbite of him a little later, believes that maybe the bull market has resumed? What we saw was a correction, and the bull market has resumed. I mean, now that statement, a bull market, the resumption of the bull market has got implications about how you'd want to think about what will do well, and what kind of positions you can take, etc., etc. Go on.
Absolutely. No, thank you very much for having me here. This is a very interesting juncture that we are in as far as the Indian market is concerned. It is good to see the Indian market performing. It has moved up almost, I think, about 7 to 8% from the recent trough. I think anecdotally, large part of this is because of short covering. There's a degree of fear of being left out, fear of missing out, as they call it. But at the same time, I would, in the near term, maybe in the month of April and early part of May, I would still be a bit cautious about declaring it as the resumption of the bull market for two simple reasons. Number one, we are yet to see the worst of the tariffs. As far as India is concerned, we are going to hit the reciprocal tariff hurdle on 2nd of April. There will be, rapid negotiations around that time, or maybe just after, to reach some kind of a trade deal. We don't know in what shape and form that would come through. So there's a lot of uncertainty surrounding that. Second, April till first half of May is the result declaration month. And in recent times, during result declaration months, Indian markets performance has not been good. Earnings estimates have always been revised down. And that's partly because almost all the company commentaries that we have seen, they always tend to postpone their timeline for a recovery. Almost all of them, be it in consumer discretionaries or consumer staples or in industrials, they almost always have kept on saying that, okay, the recovery is on the horizon, but it'll possibly take a couple of quarters from now. So that recovery timeline is getting postponed every time we hear them in any of the earnings conference calls. So, I would be a little cautious in the month of April, and possibly, in the first half of May as well. But having said that, valuations have come down a bit, both large caps and mid and small caps, more so for the large caps. We have seen FII selling reach almost about 0.6 to 0.65% of the total market cap, which is close to the previous bottom. The previous bottom was even worse. It was about 0.8688%. But, all these things put together tells me that we're possibly getting there in terms of a market bottom, but some of the fundamental concerns still remain, and which might impact the market a little bit more, over the next, next 1 to 2 months.
Manishi, hi, morning. So are these fundamental concerns that you're still sort of looking at, are they local in nature or global in nature? Because global, we don't know what happens second onwards, April 2nd onwards. The local concerns, the growth concerns, do you think that they have pretty much resolved themselves?
The global concerns are there for everyone to see. As I pointed out, they are around these, the tariff war and what kind of negotiations we see after that. The local concerns were earlier all clustered around slowdown in government spending and therefore decline in urban consumption, urban job generation, and also earnings estimates declining. I think the government capex angle that is being sorted out, but the urban employment creation and therefore consumption sentiment recovery, that is yet to be sorted out. And as a consequence, we are still seeing, if you look at Nifty or Sensex or any of the India indices, the consensus EPS estimates are still coming down. I recently published something on this, that if you look at Asia, there are possibly about 100 country sector combinations. There are about 9 or 10 of them which are showing earnings inflections, which are earnings estimates are going up after a long period of decline. None of them are from India. There are 3 from Hong Kong, China. So Chinese industrials, Chinese consumer discretionaries, some of the battery companies like CATL, they're actually showing that trend, upward earnings inflections. Not yet anyone from India, and that is possibly the most important variable that I would look forward to when deciding whether, we're past the worst or not.
Okay, so you're not taking a very clear view whether this indeed is the bottom and if everything is up from here on. I get that point of caution. But in the interim, what's the call on the market in terms of just further cash deployment if people are trying to use this to build up portfolios because dips are that good opportunity? Then what are you most constructive on here in the market?
Our point of view about sector and stock selection hasn't changed much. We were positive on financials, particularly the frontline large cap banks, and our positive stance remains there. Earnings growth forecasts are in the range of early teens over there, but when you compare that to the valuations, which have come down drastically over the last couple of years, I think large cap frontline banks, they seem to be one of the best bets in India right now. I would also talk about consumer discretionaries, not consumer staples. I wouldn't touch the consumer staples right now because they're just too well penetrated and too saturated. Consumer discretionaries, on the other hand, are the foremost beneficiaries of this recent cash injection into the hands of the consumers, about 1 trillion of tax benefits that have gone in. I would definitely be looking at the entire chain of consumer discretionaries like auto components, some of the EMC, the electronic manufacturers, who are the back-end manufacturers for the OEMs. So I think those two would be front and center as far as sector selection is concerned. I would selectively look at industrials also. I think broadly defense spending across the world, I mean, we are seeing that in Europe, but it'll have to increase all over the world. So the defense sector, other industrial sectors geared to infrastructure, those would also do well, but one has to be careful about valuations and the stability of earnings growth in those sectors.
No, I think point well taken. Just a few names here, right, before we go any further. The biggest volume-led gainer now is RailTel. RailTel was not in the mix in the morning when we started. It's up 7%. It's got humongous volumes on it, 332 on RailTel, if you can pull that up. BEML is another one, which is up 6% on huge volumes. Again, I didn't spot it in the morning at least, which is 10 minutes back. Zentech is up 5% higher, 1,500 on Zentech. Again, large volumes. There is IGIL, which is the diamond certification company, 5% higher on IGIL. MTAR Tech, from the defense space is up 8%. These are all new names which are coming up with decent-sized gains right now. Global Spirits is another one which is up 6% on some volumes, and Senco is coming up with about a 5% pop. So it's changed. I mean, the constitution of what is up on large volumes, a lot of it is now kind of rotated, and newer names are up there at this point. On the downside, Mahindra & Mahindra is the top volume-led loser. It's down 2% on outsized volumes for this point in the day. There is ITC Hotels, which has picked up some losses, 2.5% lower, 3% actually. Titan is down about 1.5%. A KEC, which was down, we mentioned this in the morning, is down 4.5%. And of course, I mean, then you've got Mankind, Dam Capital, Novama, etc. We mentioned some of these names early on. Manishi, we spoke about it. Actually, we are speaking with the management of KEI Industries in just a bit from now on the entry of some of the bigger industrial groups into the cables and wires space. The Dire Pack sold off earlier on news that Ultratech is making an entry, and now, of course, you've got the Adani Group coming in as well. Anything you'd like us to ask them?
Well, I mean, industry outlook, the industry used to be a benign oligopoly. There are like top 3 or 4 players who had very nice, cozy market share between them. But whenever a new player, largely a player with deep pockets, enters the market, there's a bit of a shakedown. And in particular for the market leaders of the present era, present generation. So I think a question about their target market shares, not right now, but maybe 5 or 10 years down the line, and the kind of niches that they would like to protect, those would be the most appropriate. And, one doesn't know what the strategy of the new entrants would be, but, what would they like it to be, and what would be their counter strategy? That would possibly be an appropriate question.
Absolutely, Manishi, and that's exactly what we'll start with. How are the incumbents gearing up to take on the onslaught from 2 big, deep-pocketed, mighty giants that are entering the sector? We'll discuss this with Keia. Thank you very much for joining in, and let's actually straight away dive into this conversation on wires and cables. It's been all about this intensifying competitive intensity in the cables and wires space. It's now the Adani Group entering after Ultratech announced its foray. These are deep-pocketed entrants. They mean business. So what happens to the current leaders? Well, we have with us Mr. Anil Gupta, Chairman and Managing Director of KEI Industries, joining in. Mr. Gupta, thank you for being here with us. I know these are times where I think, many of the incumbent players would perhaps avoid questions. But so really glad that you could join in today, because this is a concern in the market, right? You've seen the share price, not just yours. You've seen your peers, Polycab, etc. Share prices are off 15-20% since these 2 new entrants announced their intention. I remember when we spoke with you after Ultratech's entry plans, you were, fairly brave-faced. You said that the scale-up doesn't happen overnight. It'll take time. Now we also have Adani's. Let's start with the market share question. Where are you right now? And realistically, what is the disruption you are gearing up for?
Yeah, good morning for inviting me again. I think I will repeat the same what I said 2 weeks back after Ultratech announced the entry. See, first of all, it will take, I think, at least 4 to 5 years for any new incumbent to build their production facilities and make entry in the markets. Secondly, it takes a bit of time to understand that business. We are already well established. We know the market. We know the business dynamics of this industry for over. I'm leading in this industry for last 45 years. So we know that I've seen at least 4 to 5 economic cycles in this business. So Indian market is growing significantly. And I think as the economy is going to become $7 to $8 trillion by 2030, by the time these players comes and establish themselves, I think market will be more than 2.5 to 3 times from here what it is there. So it will not be difficult for the market to absorb another 2 players. And this industry is very different from cement or paint-like things where there is a strong consolidation. And,
Mr. Gupta,
yes.
Sir, allow me to ask some counters as well. The timelines that you're talking about, aren't they very long? I mean, the plans that we've heard, for instance, Ultratech is talking about 1,800 crores over the next 2 years. It won't take them 4 years to bring their product to the market, right? And also, let's set the record straight on market share. I'm going by a broker note, FY24. This particular note, I think it's Morgan Stanley. They said KEI Industries is at 12% market share, Polycab is at 26%, and Havells is at 11%. As we end FY25, what's your market share?
I think we will be around 13%. And we are building up large capacities by putting up a 2,000 crore capex by completing by next year end, next financial year end. And I think that will scale up our capacity by around 60 to 70% from the current level. And I'm confident that with our penetration in Indian market and also our growth in overseas markets, we will be able to maintain our margins as well as the growth trajectory of guided 20% over next 4 to 5 years.
Timelines, just to complete that point, you said by FY30 they'll come up with full-scale capacities. But realistically, how long does it take? I mean, I'm sure it takes lesser than 4 years to set up a cable and wires plant and come to market. What's the real time to market?
If they start planning today or start putting first brick,
today.
It will take, today. It will take 3 years to build and complete the factory. Then it will take another 1 year for stabilization of the production and the stabilization of the manpower in the plant. So that is around 4 years. That is what I am saying. And then whatever time it takes to establish in the market or put a brand, customers are not going to run behind a company just because they are big players. And this is not a product like e-commerce or a telecom where it is basically capex, and then one can lose money on the raw material or commodity or on the operation cost.
Absolutely. And I think take your points on board, Mr. Gupta. Good morning, Prashant here. So at least 3 years from now, when some of this stuff will start to happen, and we'll see how it plays out. But you're not obviously waiting, right? I mean, you're an old player. You're of course also doing a lot of capacity expansion, low tension, high tension, EHV. Sanand is something we've spoken about in the past. Could you give us a sense of your own capacity expansion? What's the cumulative capacity which is coming on stream by when? And what's the asset turn we should expect on that?
Present asset turn in our company is around 6 times. The new capacity which is coming up at Sanand, initially it is going to have an asset turn of 3, but gradually we will move it up from 3.5 to 4 over a period of 1 to 1.5 years after it is by 27-28. And we are talking of reaching a capacity level of approximately 17 to 18,000 crore rupees within next 3 years by FY27 or FY28. And we are also working on a lot of backward integration, and also will be coming up with another capex in next 2 years to scale it up to around 25,000 crore by FY30-31. So that is our plan. And I'm sure that with the kind of growth in the Indian economy, we will be able to reach that sales level, and also our projection of taking 20 to 25% of our turnover from the export markets. And there's enough room for the 2 other players to come in.
Well, I remember, Mr. Gupta, no, absolutely. I remember last time we spoke, you said the domestic demand is about 1 lakh crores, approximately 1 lakh crores, right? Say the incremental demand in the industry every year is another, 13, 14, 15,000 crores, if the industry is growing by that much. What you told us right now, capacity is basically going to come up in the next 2-3 years, roughly around the time 3 years when a lot of the other capacity will come up as well. Could you give us the total sort of demand, domestic demand by then? And what will, you know, my question is, will the capacity utilization for the incremental sort of demand going to fall short? Will capacity utilization suffer because of all the new capacity which is coming up? Have you run those numbers, sir? Is it possible?
I don't think that, we will be, because we are very established in this business. So, and newcomer will always take time for getting utility approvals or customers approvals when they enter the market. So I'm sure that we will be able to maintain our growth rate of 20%, projected growth rate of 20% over next 5 years.
Mr. Gupta, just one last question. These tariffs on the US side are going to come into force, right, from the 2nd of April. Any way to think about it for your industry? Any implication at all? I mean, this is largely a domestic-driven story, but any thoughts?
Our, market share in US is negligible. At the moment, I can say that we are doing around 300 to 400 crore a year, and by next year we expect to take it to around 800 crore. So, which is a negligible market share, and I don't think that there is going to be a big impact on our company due to even if hefty tariffs are levied. But I'm also not presuming that India will be enforced too much of tariff by Trump administration. So let us wait. I mean, we can't speculate on that.
All right.
Mr. Gupta, 20% CAGR growth top line over next 5 years. And what's the kind of bottom line growth or rough margins despite all this disruption next 5 years?
I will be very conservative. I will still like to maintain around 11% margins, because even if the disruption takes place, so we will be able to maintain this much of EBITDA margins.
Okay, Mr. Gupta, we'll leave it there, sir. Thank you very much for joining us. And second time over, right, on the same topic, but different player who's announced an entry into the space. Thank you indeed. Well, I just want to quickly look at the market. The Nifty will come up. The intraday will tell you that we've come off a little bit from the day's high. But more importantly, we should put up the small cap index, the intraday. Their gains have been pared back significantly. So, yeah, there you go. From the high point, I think very sharp fall. And the mid cap index will come up on your screen as well. There as well, I think there is a pairing of gains which has happened on your screen now. But overall, things are looking pretty good, 0.5% higher. Time for a quick commercial break here. We're going to come back. The management of BSC, MD and CEO, Sundaram Ramamurthy, with us on the other side.
Welcome back. As promised, we have a very, very special guest with us. The big boss of BSC, Mr. Ramamurthy, is with us here on CNBC-TV18. Thanks a lot, Mr. Ramamurthy, for speaking to us here on CNBC-TV18. And first of all, before we get to business, congratulations to BSC, all the investors, traders, and every Indian as well, as you'll complete 150 years. It's been a long, long journey from under the banyan tree to Dalal Street. Give us your first take on that.
Namaskar for having me with you today. Yes, it's a very proud moment for the country, the stock exchange, and the investors of this country, and to all people who have contributed to the growth of this wonderful organization. From banyan tree to this place, what you were talking, if you look at it, from few people trading to a pit-based trading to today, a totally democratized access to markets and information is what BSC stands for, thanks to the regulatory developments in India and its journey along with it. At this moment, it is very important for us to stand for a moment and think of all the great contributions, all the great people who have been heading this organization in these 150 years have done for the growth of this company, the growth of the economic development of the market, and making India shine as one of the stars in the entire world.
Indeed, Mr. Ramati, congratulations on that, and all the best for the next 50 years. May it be even stronger for all of you. Well, let's talk about business then. You know, the National Stock Exchange has gone ahead and they've tinkered with the expiry day, right? They have shifted it to Monday. The question is BSE thinking of changing your expiry day? That's going to be the big question. Have you had a look at it? And by when could we hear a response coming in from the BSE in terms of tinkering with the expiry day, or will you all stay status quo Tuesday?
As you may recall, I was working with NSE for a significantly long time.
Indeed.
Since inception of derivatives in various facets of market development, investor protection, investor awareness creation, surveillance, clearing and settlement. Thursday has been a hallmark expiry day for a significantly long time.
Right.
With introduction of multiple products, there were expiry days on all days, which left only BSE to choose Friday at that point of time to have an expiry day. The past has told us clubbing expiry days to a single day does not help in the product serving its utility for the market. Okay. The product, for example, sensex expiry coincided with Thursday expiry for a very long time. And despite multiple efforts, sensex did not take off. Yeah. And when we changed the product specification, the utility of the product was visible. When we made it very close to Thursday, because we had no other choice, while its utility was not coming out in full. Yes. The concentration of trading activity on the expiry day was far higher. Yeah. And today, when we shifted it to Tuesday, interspersing with time, the concentration on expiry day activity has almost halved, very clearly indicating the economic significance of a product could be well achieved, particularly if it is a highly correlated product, by interspersing some amount of days in between, by properly spreading the contract so that people will use it for the desired purpose of hedging themselves against volatility for different periods of time across the week, across next week and across month. That is our thought process. So far as what is going to be BSE's stand is the market feedback that we received from people whom we approached and people who approached us. The point that underlines is that there should be a spread between two expiries. Okay. What it should be, how it should be are nuances. We need to see how the market spans out in respect of all this. Since we are having too many other realignments already happening, anything done in a hurry will not help in the product development and economic development. So at this point of time, we are assimilating all the announcements, changes, and we will come out with a stand, what will be useful for the product.
All right, two-part question, sir, on that. What's the probability of you changing the expiry day? Is it high, going by what you have got back in terms of a feedback? Point number one. Point number two is, by when will you respond to this? If there is a change, it appears that for April, there may not be a change. You can correct me if I'm wrong on that. By when do we hear a response from the BSE?
See, I would like to reiterate that BSE's expiry was next to NSE's expiry of Nifty and Bank Nifty for a significantly long time when it was relaunched, notwithstanding that Sensex was trying to find a feet. But only thing what it was not able to achieve is proper economic significance of itself. So whether in the revised situation when BSE Sensex is establishing itself as a clearly important product, what should be the action should be carefully thought about. It cannot be defined in terms of time horizon. Okay. It has to be talked about in terms of the entire realignment.
Indeed. But there's a probability you'll look at changing it.
No probability can be ever ruled out. Only ascribing a percentage high or low will be very difficult at this point.
All right, Mr. Ramamurthy, let's tell you then what the street believes. You know, they believe that BSE, the rough market share is in the early 20s, you know, around 22% or thereabouts. And they believe that, in fact, because NSE has gone ahead and tinkered with the expiry day, BSE could lose market share. Do you think that's the case?
So here, no, I need to clarify to you, as I have always been telling to media and press, BSE in derivatives will not run behind market share. Because we always believe BSE's market share is 100%. because the product is unique, right?
But investors want to know, sir, because your market share has gone up and you'll have gained significant traction from the time you came at the helm, from the time you all tinkered with your expiry day as well. So the street's fear is you lose market share now. Respond to that.
So the point that I would make is BSE strives very hard to deepen and broaden market. When you deepen and broaden market, what you term as market share is actually a corollary. That is not the main goal. What do we mean by deepening and broadening of market? We want more investors who are eligible to trade in derivatives to trade.
Okay.
We have more FPIs to trade who have long-term perspective on the Indian market. We have more brokers. We have a farther spread. That's what we will work upon. Whatever product change, whatever product development effort required to achieve this is what we will do. That will by itself result in whatever market share it has to result in.
Okay.
I would also reiterate, BSE's expiry was next to the expiry of two big contracts of this market when it gained its foothold and started growing. So it is very difficult to predict what the market would be in future based on one change. Does that close out any option? Certainly not. Does it create any jitter or fear? No. Because the goal is very clear. The goal is deepening and broadening market.
Okay. All right. Let's drift away then. Let's talk about the SEBI consultation paper that's come out. The fear is that the trading volumes will get curbed and in turn, it could impact your turnover, the average traded quantity as well. Could you tell us what are the key takeaways that you have seen in this consultation paper and also any kind of recommendations, any thoughts on this SEBI consultation paper?
Very good question. The SEBI's role inter alia has two important points. One is market development and the second is investor protection. If you look at all the activities of SEBI with regard to derivatives, with regard to anything till now, and particularly with regard to derivatives, what we have been seeing since October, has been to achieve this twin objective. The objective of no regulator will be to curtail the market and make its liquidity dry up. At the same time, along with development, it should also be worrying about investor protection. If you look at all the discussion that is happening, it's all happening in that way. The key takeaway for us is, this is the goal and this is the process. In the process, always there will be some outcome from the expert working group.
Yes.
But SEBI does not feel it is complete without taking the consultation from public. That is the very reason why the consultation paper gets published. Multiple people have given a lot of feedback is what we are hearing. How to ensure that there is an open position limit, particularly I think in terms of index derivatives, which is very heavily talked about. How to have an open position limit at a client level, at the same time aid market development. Regulatory process in India is a very healthy and co-created process. Regulators have not ever acted in a silo without consulting market views. So I am sure this time as well, while expert group has come out with a consultation paper to seek and solicit views from the markets, and which has come out in a very big number to the regulators, all these factors will be considered, and the appropriate time, with the appropriate time, the right thing for the market to ensure the twin objective of market development and investor protection will be done by the regulator. That is our strong feeling.
Okay, all right. The market has gone a little bit soft in the last few months, and there's been a bit of a correction as well. There are also curves that could probably be in the offing. What is the fall you have seen in total turnover from BSE if you compare it with averages of the recent past? How much lower are volumes, in the last month or so in comparison to earlier?
In terms of cash market, while the average daily traded volume has grown up for us, in terms of percentage, market share, it has not grown up significantly. It's hovering around 6.5 to 7%. In between, it touched up to 10% to 10.5%, but it is not growing. There are a host of reasons for it. Some of the major reforms which are in the offing are yet to take off for various reasons. One is common contract note, which has been a huge demand from the institutional players. For various reasons, it has been getting postponed from October to November, now to April 30th. We hope that it should come out. The second is, the next important participant in cash market is retail. For the retail to participate, the mobile apps are very important. Many a times today what you find is the mobile apps provided by the brokers do not afford level playing field. There has been quite a few SEBI interventions in this regard. We hope all of them will fructify. Any directive directly to from the regulators to the brokers will also help in this area. So that is the second thing which is work in progress. If these two happens, people who are liquidity providers will come into the market. We feel there is a huge potential for a complementary growth of BSE in cash market. There again a complementary growth where the pie itself can grow and BSE's market share can grow.
As of now, you're saying BSE's market share is around 6-7% or thereabouts in the cash market, and cash market volumes haven't really got impacted.
No, they have gone up slightly as average daily traded
and that
volume.
was something that you spoke about in the past as well. You said maybe the derivatives market volumes will fall, but you'll see a shift towards the cash market volumes. So you had briefly spoken about this in the past as well. In the derivatives market, what is the volume fall? And if you could tell us, what is your updated market share over there?
So overall, the notional turnover across the exchanges, I think has come down by around 40%, and premium has come down by 17%. While I would continue to reiterate my earlier stand, we don't run behind market share. Our market share is 100%. In terms of what numbers you ask, for your question purposes alone, the notional volumes have fallen down in BSE by around 17%, etc. No, the premium volumes have been stabilized as far as sensex is concerned. There has not been any significant fall, but that I will call as a catch-up part and also a process of realignment. BankX is not seeing much volumes because it will take time for it to develop as a monthly product as against a weekly product.
Okay, all right. Very quickly, sir, there is that clearing cooperation dispute between the exchanges, and reports suggest there's been a nudge from SEBI to bury the hatchet and move on. Is there any such talks about that with regard to these reports, the clearing cooperation dispute that's currently in the works? And also just one more, since we're talking about NSE, there is this guarantee fund that they have, settlement guarantee fund. And since y'all are growing in terms of volumes as well, do you believe that you'll have to provide on that aspect as well, clearing cooperation as well as SGF? Please go ahead, sir.
So as of today, BSE has no dues towards any clearing corporation whatsoever.
Right, but now volumes are going up. So will you make a provision in the time to come?
You're talking of SGF?
Yes.
I was replying the earlier question.
All right, okay.
So as of now, BSE does not have any dues to any clearing corporation.
Yes.
What I understand is NSE has some dues to be paid to ICCL. Indeed, the matter has been raised to the regulators by both the parties. I am sure as matured exchanges and clearing corporation, there will be a solution in the offing.
Okay.
With regard to SGF, there is always a problem with regard to SGF because the algorithm is very difficult to predict what could be the SGF requirement. What you could predict, you could provide for.
Yes.
If the algorithm is not conducive, if there is a past for you to sort of rely upon and see what could be the number, that also could be provided for. As you would recall, despite multiple effort by various people in the past, till the last 2 years, BSE has not been seeing any activity either in its exchange or in its clearing corporation. Things are changing a bit. So we need to study how the SGF behavior is with regard to ICCL. If we can find an algorithm whereby we can sort of forecast what could be our contribution, then it could be provided as an expenditure in P&L on a proactive basis, and then it could be substantiating SGF. But it is some time. It is some work in progress. It's not easy.
All right. The other one, work in progress, is the NSE IPO. Will it be competition, or how do you view that? You have been part of the NSE in the past as well. That's been the big buzz.
I'm no longer part of NSE. This is a question well answered by NSE.
Okay. All right. Thanks a lot, Mr. Ramamurthy, for speaking to us here on CNBC-TV18. Congratulations on the 150 years. And thanks a lot for clearing out a lot of those doubts.
Namaskar.
Back to you all in the studio.
All right, Nigel, thanks for that. Very, very interesting conversation there with the BSE talking about overall drop in, of course, F&O volumes as the regulations have been tightened. Their market share now are about 6 to 7% in the cash market, that is, and they're hoping that that will continue to grow. And, of course, looking at more clarity on several regulatory issues. Just a quick word back on the street and look at the rise. I mean, it's a beautiful bounce. That's the BSE stock. Let's pull up the Nifty itself. Days high on the market, looking strong and steady. The market has now conquered the 100-day moving average as well. And once again, it's a wide move. It's across the length and breadth of the market. Most sectors are moving higher. Mid-caps are moving higher. Pull up the mid-cap index. It's up about 1% as well. Bank Nifty is leading from the front. It's up about 1.5%. That's the Bank Nifty move. So big green day once again, and the market's continuing to charge higher. Well, let's play out some more snippets from my conversation with market veteran Ramesh Damani as part of our series Market Cafe. I asked Ramesh about the here and now, whether the market has completed its correction and what the future course is. Ramesh says that the bull market run has resumed and what we saw was simply a small correction in an ongoing bull market. He also talks about why he's not too perturbed about the direction of FPI flows.
The good news would be is that in my opinion, again, these opinions can be wrong, but in my opinion, we're in an ongoing bull market. What happened was the first correction in 4 or 5 years, it was particularly severe. And market correction is always severe. It always kind of panics you and tests your conviction, tests your patience, which is all the things that it did. But they are short, sharp, and swift. As you saw, the index fell very sharply and very swiftly, almost without respite, 800,000 points a day after that. But my feeling is that that is just a correction in a bull market, not the topping of a bull market. The reason I say that is even when the fall started, individual stocks were making new highs, new all-time highs. Bajaj Finance, United Phosphorus, Shree Cement, so many companies, good high-quality businesses were making new high. That would typically not happen in a bearish phase of the market. Secondly, more importantly, in the last 60 to 90 days, I put, I had the road, rubber meet the road, went and visited a lot of companies, just try to get feedback on what things are in corporate India out there. And almost universally where I went, people are talking about expansion, talking about growth, talking about margins, talking about profitability. So this was more of a market event than an economy event. There's very little leverage in the system. Banks are not leveraged. The stock market was not leveraged. So it was just a correction of valuation, which had probably become excessive, took place, and now we're resuming the bull market that began in 2021.
Well, that's really good to hear because, absolutely. I mean, we couldn't really pinpoint an economic crisis or a financial accident which triggered this. It kind of, just happened on its own. On valuations, and that's why it's a little, important to understand both valuations and the power of flows. Domestic investors were pretty much buying throughout it, and yet the market fell because we were being hit by 8,000 crores, 10,000 crores of foreign selling on a daily basis, right? Now they've stopped selling. In fact, now first trickle of buying has come through. So while we can't predict flows, perhaps we can't underestimate the relevance also, right?
You can't. I appreciate that. And a lot of my friends pay a lot of attention to the FI number, which I really don't. Because anytime there's a transaction on the stock exchange, there's a buyer and a seller. So if the foreigner is selling, someone is buying at the other end. Stocks don't go in a zero hole on the ground. I mean, there's always a buyer at the other end of the stock. So things are being bought. Someone who thought it was expensive of selling it or booking profits, someone who thinks it's value and he can make money, so he was buying it. So, that takes it. Of course, it's important. I'm not denying the importance of the FI number out there. But I don't particularly pay too much attention to it. It's just one of the things we look at out there. What we particularly pay attention to is on the ground, what's happening. Is the company, how is the company dealing with the Trump tariff? How is the company dealing with inflation? How is the company dealing with the changing technology environment? I think those are more relevant questions for an investor to ask in a bottom-up manner. And I think that's just noise that you can't control. If you're going to sell tomorrow, how do you control that? If oil spikes up, you can't control that. If Ukraine war ends or does not end, you can't control that. But you can control what you buy. And you want to buy those businesses that are, doing good, bulletproofing themselves. And which is what I've done, which is what has been very successful the last few years.
Fantastic. Take your point completely. There's always a buyer on the other side.
There always is. So, what does it matter?
The color of money doesn't matter. There's someone putting in the money.
Psychologically, it matters, but actually it doesn't matter. The shakeout has been good. It has tested you. It has, proven that you have a conviction in what you buy. And there's no something called easy money on the large street, as everyone thinks that I buy today, make tomorrow, which had gone on for a few years. But all the veterans have told you that, wait, when the correction comes, people will panic. But I think if they hold true to the flag and, I think it's great. I think the domestic money prospering or domestic India is great. We welcome foreign money, we welcome foreign capital, but they have a right to sell and I don't begrudge them that.
So absolutely, Ramesh. I mean, I completely agree with you. May this wave of domestic money, may it become a tsunami and may it continue for all our sakes. But my question was more sort of regarding valuations and whether so much of domestic money continuously coming in the market, whether that will sort of create its own valuation challenges.
Surabhi, the market has a self-correcting mechanism, which we just saw. I mean, the index fell, 10, 12% from the peak. So it has a self-correcting mechanism built in. When valuations get too high or too stretched, someone on the other side will say sell, and it cannot be absorbed by the market, which is exactly what happened. So why worry about it? It's market has a self-correcting mechanism. If you take stocks to unbelievable heights, the short seller will step in, or the promoters will sell in, or the insiders will sell in and want to encash it. So that will act as a natural check on the market, which it has done. As long as there's not any undue amount of leverage in the system. There was, I think, 70,000 crores of margin funding, which is the size of a small mid-cap company in India today. So there's no leverage. The banking system has no leverage. The government had fiscal restraint. So, in fact, money was tight. So there was no reason to believe that this would be a long-lasting bear market. And market will correct itself. Anytime the valuations of something become excessive, people step in and sell, insiders sell, someone sells, and that creates a buying opportunity.
Okay, so there you hear Mr. Damani sounding optimistic on India as always and saying that this was just a small phase of a correction in an ongoing bull market. Market Cafe Season 2, more from that conversation coming up through the week. With that, let's take a very quick break. We'll come back on the other side and get you the latest on the commodity markets as well. Of course, the equities are roaring. Manisha will join us with the latest from the commodity side. Welcome back. Equities doing very, very well this morning. Like we were saying, 200-point rally on the Nifty. But let's find out what's happening with commodities. We have Manisha with the latest.
Well, thank you for that. I'm looking at copper as prices because we've seen very strong gains onto this one. If you look at the last couple of weeks, copper clearly is an outperformer, and it is an outperformer when you look at the overall base metal as a sector as well. I want to put forth on what we've done in various exchanges because that really tells the story. So when you look at the copper prices on LME, we've gained up by 12%, and we are like about $800 away from all-time highs. But when you look at the COMEX copper prices, we are up by 26% and at all-time highs. I mean, if you look at both of these markets, you can see that disparity that the global markets right now are working with in sense of copper there. Well, to begin with, the US is talking about putting tariffs on imports. This could happen as early as in the next quarter or by the end of this year. US imports nearly 45% of its copper requirements, not just in the conventional market, but copper is also now required for generation, AI, energy transition. So copper requirements going forward is going to be quite huge. So with the reviewing of happening on when this import tariff will be put, we've seen that premium build up in case of prices. So when you look at the US prices, we've hit a premium at a record high of $1,400 a ton. So if LME is trading at 10,000, you have copper at US trading at $11,400. I mean, that's the kind of disparity that there is into the markets. Also, when you look at the imports that are happening in case of US are at around record highs. Monthly, you have 70,000 tons of copper imports happening into US, but the last couple of months have seen 150,000, so more than double therein. And also, when you look at the US scrap exports that usually have been happening all of these years, those also seem to have dried up. So all copper, refined, not refined, scrap is staying in the US markets at this point in time. Now, that brings you to the rest of the world, and especially China, which consumes nearly 50% of world's copper. Usually, when the copper prices used to run up, China would stop buying, and that would lead to correction into the markets. Now, at these higher prices, even if China does not buy, you are looking at all of that copper actually going into the US markets. And then apart from that, Chinese demand is picking up because the manufacturing activity is picking up. You also are looking at more stimulus measures coming in. Also, the Shanghai copper is trading at the widest backwardation in more than a year. That tells you that the copper is more expensive right now and cheaper perhaps going forward after 16 to 18 months. So this is the time that everybody wants copper, and that's showing into the prices. Interesting report from Mercuria, which says that the global demand will see a deficit of around 320,000 tons in year 2025. There is a similar report that we also have seen come in from Goldman Sachs, which sees a deficit of 180,000 tons in this year and 250,000 tons in the next year as well. And the last chart should tell you on where markets are anticipating copper prices from here on. So $10,900 of an all-time high is what we saw in copper prices in the previous year. You have ING expecting averages to be lower. Goldman Sachs believes new all-time highs coming in. Morgan Stanley is looking at an average of 9,500. Citi talks about 10,000 in the very near term. And Mercuria continues to be very, very bullish. $13,000 a ton is what they're expecting in case of copper for this year itself.
Okay. All right, got that, Manisha. Thank you very much. So, copper in sharp focus today. Well, just once again, before we take our next break, let's just dive a little deeper into what's behind this extremely green-looking stream on the large cap space. The gainers, banks are leading from the front, like I said. So, Kotak Mahindra Bank, Axis Bank doing very, very well. Even the larger peers. Let's pull up HDFC and ICICI. HDFC Bank itself is contributing a lot, 1.5% higher, as is ICICI Bank. Let's pull up the Nifty contribution chart because the banks are one part of it, but there are more legs to this rally. A lot of the other blue chip heavyweight stocks like Reliance, like L&T, they're all participating, which is why things are looking quite healthy. There we go. So you've got the banks. There's also Reliance, there's L&T. On the downside, there's some selling in Titan, which is very, very clear. Let's pull up the Titan chart. It was down 2.5%, almost, last I checked. And of course, M&M is also correcting a little bit. M&M is, along with a lot of other auto majors, has announced price hikes starting April, and that's Titan for you. Very quickly, let's go across to Mitesh for a final roundup of trades. Mitesh, what's the advice now?
So, on the Nifty, we're getting close to the level of 23,550, 600, which is where, I suggested could be one target, though eventually we are even looking at 23,750 and 24,000. But I think a good idea would be to take some profits over here. Trail your stop loss is now to about 23,400. And if you get a 80, 90 point kind of a dip, you can re-enter on those longs, which are partly being booked. So I'm still positive. But looking at the magnitude of the rally in the last, during the last week and today, Monday, first session, I think we are now hitting an important supply pivot. So I think it would be wise to take some profits. Although I think the trading bias remains on the long side and therefore I have buy calls. But on the index, we are taking some profits. For the timing on the stock side, PNB is a buy with a stop at 94 for targets of 99. And Policy Bazaar is the other one, which I like. That's a buy with a stop just below levels of 1630. So 1628, 1627 could be a stop. And look at a target of around 1755 to about 1760.
Okay, all right. Those are some of the trades. Mitesh, very quickly on banks, still, since that's emerging, banks and financials is emerging as this big trade. What is looking better? The leaders like HDFC, ICICI, would you look at tier 2 names or some other NBFCs? What's your best financial trade?
I believe that, and disclaimer, I have some positions over there. I believe that in the near term, I think it's Kotak Bank which would lead the entire pack. See, Kotak is something, which for the last 3-4 years was sideways. And, we never saw stock sustain beyond levels of 2050, starting from way back, from about February of 22. And now we are beyond those levels. So I think Kotak Bank, while there is some target of, some historical pivot around 2170, 80 zones, I'm looking at a target of 2,400 to 2,500 in the next few weeks and months. So very, very positive over there. I think Kotak could do best. That about Axis, ICICI and HDFC Bank also look good to me. And you can add the State Bank of India.
Okay. All right, got it, Mitesh. Thank you very much for the quick trades. We'll catch up with you later during the course of the day. Let's now focus on the oil and gas space. Remember, Sudarshan, before market opening, had alerted us that there is some discussion about maybe some change in, pipeline tariffs. And this could be beneficial for names like GAIL and GSPL. That's exactly what we've seen, actually. So these stocks have been doing very well today. Just remind us about the issue.
So most of the stocks from gas sector are higher, like GAIL, GSPL, even city gas companies. You can see IGL is up more than 3%, even MGL is currently higher. It's in the back of because PNGRB, which is the gas regulator, has put out the draft on its website proposing certain amendments or changes to natural gas tariff regulations. And because of that, you are seeing a big move in these stocks. Some of the brokerages also have written on the proposed changes. Citi says fuel cost, that is price of contractual LNG, can now be claimed if you go by the amendments that PNGRB has proposed, and that can benefit big time to GAIL. Second, there is less stringent volume assumptions once volume crosses 75% threshold. That can benefit companies like GSPL, and because of this you are seeing a big move. CLSA says regulations could lower operational expenditure for city gas companies like IGL and MGL, and both these stocks are higher, more than 3%. Also GSPL and GAIL, if these proposed amendments are implemented, tariffs for both these companies can increase for natural gas pipeline. And last is, there might be an increase in cost of gas users, including industrial customers of Gujarat Gas. Stock is higher, but this can be a minor negative for Gujarat Gas. So because of these proposed changes, obviously PNGRB has sought that if anyone wants to reply, they can reply by April 11. But for now, on the basis of these amendments, these stocks are trading higher.
Okay, all right, got it. Sudarshan, thanks very much for that. We will take a quick break on that note. On the other side, Lata speaks to the MD of AU Small Finance Bank, Sanjay Agarwal, as the bank clarifies on rumors of the CFO's resignation and also, of course, gives a growth outlook.